JD.com stands as China's largest online direct sales retailer, a company that has distinguished itself from peers like Alibaba and Pinduoduo through its unwavering focus on authentic products, lightning-fast delivery, and a disciplined corporate culture. Where others compete on sheer scale or discounts, JD built trust and efficiency into the very backbone of its operations, earning the loyalty of millions of consumers who value quality and reliability above all. The market took notice. In May 2014, JD.com went public on the Nasdaq at $19 per share, raising $1.8 billion and signaling the arrival of a serious contender in global e-commerce. In June 2020, JD made its secondary listing in Hong Kong at $26, a move that reflected both domestic investor enthusiasm and a desire to strengthen its ties to the Chinese market. Then came the COVID-19 pandemic. Lockdowns sent millions online, and JD.com thrived. Delivery demand surged, and its profits soared. The US ADRs peaked at $98.26, while the Hong Kong shares mirrored this frenzy at $408.60. Investors chased the stock with feverish optimism, swept up in the dual forces of pandemic-driven e-commerce growth and JD's reputation for reliability. Yet as the pandemic-driven demand faded, the euphoria evaporated. By August 2024, the US ADRs had fallen to $31, with Hong Kong shares around $121, a mere fraction of their peak. The stock that once symbolized unstoppable growth turned into one of the most criticized and hated Chinese tech equities, with investors on forums venting frustration, calling it trash, dead, or garbage. Even as analysts renewed their confidence with fresh buy calls in recent months, the market has remained stubbornly unconvinced, leaving JD stuck in a prolonged slump. Adding to the bearish sentiment, Singapore's sovereign wealth fund slashed its stake in JD.com by 87%, signaling a loss of confidence among large institutional holders. So here's the question that hangs over JD.com today. At these levels, is JD.com a bargain, poised to become a potential multi-bagger, or has it become a value trap, a cautionary tale of past glory and present disappointment? The lackluster performance of JD's stock in both its US stock and Hong Kong listings reflects this very uncertainty. Hi, my name is Freeman. I'm an independent investor focused on US tech stocks, as well as listed equities on the Hong Kong and Singapore exchanges. Over the years, I've invested in China's big tech companies because I believe in the long-term prospects of China's economy as it transitions into a high-income, industrially modernized nation. Back in 2021, at the height of the COVID-driven e-commerce boom, I took a moderate position in JD.com. I was deeply impressed by the company's growth trajectory, its logistics strength, and its leadership in quality and delivery speed. Unfortunately, as China's post-COVID recovery turned lukewarm, JD's growth slowed, and its share price slid dramatically. Like many fellow investors, I'm still holding shares bought near the peak, trapped in a painful position. Today, JD trades at just a fraction of its former highs. At these depressed levels, I'm tempted to buy big, but the question remains, is this a value trap or a long-term multi-bagger? For this discussion, I'll focus on the Hong Kong listed shares, ticker code 9618, rather than the US ADR. I prefer owning the real company with full shareholder voting rights rather than an ADR structure, which represents a contractual claim to the company's financial interests rather than direct ownership. ADRs also carry an additional layer of geopolitical risk, especially given the possibility of US-China tensions leading to delisting. A quick disclaimer here. I'm not a financial advisor. Everything shared in this video reflects my personal investment journey and opinions and should not be considered financial advice. Please do your own research before making any investment decisions. When it comes to stock selection, Philip Fisher's classic framework offers one of the most insightful lenses for evaluating businesses. In his timeless book, Common Stocks and Uncommon Profits, Fisher outlined 15 critical questions designed to qualitatively assess a company's growth prospects, operational excellence, financial strength, management quality, and competitive moat. In this video, I won't be applying all 15 of Philip Fisher's principles to JD. Instead, I'll focus on those most relevant to the company's growth prospects and its competitive moat. By examining these areas, we'll naturally touch on JD's operational excellence and the quality of its management, since these factors are tightly intertwined with growth and competitiveness. From there, we'll take a quantitative look at the company's financial health and current valuation, before exploring both the potential upside surprises and the risks that come with investing in JD. Philip Fisher posed 5 fundamental questions to assess a company's growth prospect and competitive moats. Does the company have products or services with enough potential to significantly increase sales for years to come? Is management committed to continuous development of products and processes to sustain growth? How effective is the company's R&D effort relative to its size? Does it have a superior position in its industry, brand, technology, or cost advantage? Will the company's industry and products remain relevant over the long run? To really answer these questions, we need a reality check. Let's step back and look at JD's story so far and what it's been doing lately. When talking about JD's story, nothing is more telling than its remarkable revenue growth trajectory. From RMB 362 billion in 2017 to RMB 1.16 trillion in 2024, JD has more than tripled its revenue in just 7 years. This achievement is especially impressive given the headwinds of a global pandemic, stringent regulatory oversight, and a slowing Chinese economy. While growth has recently moderated to mid-single digits, the sheer scale and diversification of JD's revenue streams highlight a strong foundation for future expansion, particularly as new business segments continue to gain momentum. At its core, JD is China's largest e-commerce retailer by revenue, commanding trust for its authentic products, fast delivery, and reliable service. This appeals to the growing middle class and premium consumers who are driving the consumption upgrade trend, favoring quality over low-cost alternatives. JD Plus, the premium membership program, has surpassed 35 million subscribers, indicating strong loyalty among high-spending users. JD isn't stopping at e-commerce. It's actively investing in new growth engines. Healthcare, through JD Health. This is the largest online healthcare platform in China, holding over 30% market share in online pharmaceutical retail. It benefits from rising digital health adoption and strong post-COVID retention. Fresh food and grocery through 7 Fresh. Expanding in Tier 1 and Tier 2 cities, 7 Fresh sees repeat purchase rates above industry norms, meeting the growing demand for premium groceries. Food delivery. In a market dominated by Meituan and Elite Me, JD is gaining traction fast. By June 2025, JD Takeaway achieved 25 million daily orders, an impressive figure for a new entrant. Its central kitchen concept ensures hygienic, standardized meals, leveraging JD's logistics strength to stand out in a highly competitive space. International expansion. JD's 10 billion growth plan drives partnerships with top global brands, while its Okama concept, also known as Joybuy, in Europe has received strong feedback. The potential S'economy acquisition could add 1,000 plus physical stores, accelerating JD's footprint in key European markets. In short, JD is transitioning from a domestic e-commerce giant to a multi-sector, globally ambitious platform. If there is one defining trait of JD's management, it is their willingness to take the hard but strategic path. Unlike many peers who embraced asset-light business models to please capital market, JD chose to pour billions into building an unparalleled logistics infrastructure, including warehouses, last-mile delivery, and cold chain capabilities. This strategy was capital-intensive and unpopular among analysts in the early years, but today it forms JD's deep moat in reliability and speed, a competitive edge competitors cannot easily replicate. Recent leadership developments also signal renewed strategic focus. Founder Richard Liu returned to an active role in 2022 after previously stepping back. His comeback is widely seen as a push to reignite JD's entrepreneurial spirit, sharpen execution, and restore investor confidence amid fierce competition and slowing macro growth. Liu's philosophy has always been long-termism over short-term gain, which aligns with JD's history of building structural advantages rather than chasing hype cycles. This combination of visionary leadership and operational discipline is a strong indicator that JD is committed to sustaining growth even at the expense of near-term margins. JD's commitment to R&D is evident not just in numbers, but in operational outcomes. In 2024, JD spent approximately RMB 17 billion on R&D, roughly 1.5% of the revenue. While the percentage appears modest compared to global tech firms, the absolute figure is massive, supporting world-class innovation in logistics and automation. The most visible outcome of these investments is JD's logistics network, widely regarded as the most advanced in China's retail sector. The company operates over 3,600 self-operated warehouses and multiple highly automated fulfillment centers under its Asia #1 program. Some facilities leverage automated storage and retrieval systems, as well as the automated guided vehicles, boosting efficiency by 150% and enabling scalability. This infrastructure enables JD's famous 211 delivery promise, which guarantees same-day delivery for orders placed before 11 a.m., next-day delivery for orders placed before 11 p.m. The significance of 211 cannot be overstated. It set the industry benchmark for delivery speed in China. Where competitors rely on third-party couriers with unpredictable timelines, JD controls the entire process end-to-end. This speed and reliability build immense customer trust and loyalty, particularly among premium buyers and time-sensitive shoppers. Additionally, JD's automated warehouses in Europe use robotics and AI for smart order picking, achieving efficiency gains of 2.5 times over manual operations, proving that these innovations scale globally. Behind all this is JD's 18,000-strong technology workforce, of which nearly 80% hold advanced degrees. This talent pool continually refines JD's automation, supply chain, and digital systems, showing a direct and deliberate link between R&D spending and long-term competitive advantage. Having reviewed the background, let's now address the 5 key questions posed by Philip Fisher. These questions are designed to help us assess JD's long-term growth potential and competitive strength. First question: does the company have products or services with enough potential to significantly increase sales for years to come? My score here is 4.5 out of 5. Why? JD's core e-commerce remains a massive revenue engine, supported by China's consumption upgrade trend. But what excites me also is the momentum from adjacent businesses. JD Health dominates online healthcare with over 30% market share. Food delivery is scaling fast, hitting 25 million daily orders as of mid-2025. And internationally, JD is expanding through Okama and a potential Seconomy acquisition, which could add more than 1,000 physical stores in Europe. So, the answer is yes, JD has multiple levers for sustained growth, even beyond its core e-commerce retail business. That said, it's important to stay realistic. China's macroeconomic headwinds, from a slower-than-expected consumer recovery to structural adjustments in the economy, could weigh on the pace of growth in the near term. Second question: is management committed to continuous development of products and processes to sustain growth? Here, I give JD a full 5 out of 5. Management has consistently taken the hard but strategic path. While many competitors embraced asset-light marketplace models, JD poured billions into building its logistics network, warehouses, last-mile delivery, and cold chain systems. That's a move that wasn't popular with analysts early on, but it's now JD's strongest moat. And let's not forget, Richard Liu's return to a more active leadership role in 2022 could be a game-changer, signaling renewed focus on execution and long-term vision. This is a management team that prioritizes structural advantage over short-term gains. Third question: how effective is the company's R&D effort relative to its size? My score is 4 out of 5. JD has been consistently allocating about 1.5% of its revenue to R&D in recent years. The percentage looks modest compared to global tech giants, but the impact has been enormous. JD's 3,600 self-operated warehouses and its Asia #1 automated centers showcase cutting-edge technologies like robotics and automated guided vehicles, boosting efficiency by as much as 150%. The most visible outcome of this investment is the remarkable 211 delivery, which has set the industry benchmark in China, creating customer trust and loyalty that rivals struggle to match. In short, JD's steady R&D investment, though modest as a percentage, translates directly into world-class logistics execution and a durable competitive moat. Fourth question: does JD have a superior position in its industry, whether through brand, technology, or cost advantage? My score, 4.5 out of 5. JD owns the strongest logistics network in China, something its competitors cannot easily replicate. Its brand stands for authenticity and reliability, which appeals to premium consumers, especially as China shifts toward quality consumption. And thanks to automation and scale, JD enjoys cost efficiencies in fulfillment that new entrants simply can't match. It's not the absolute marketplace leader like Alibaba, but in direct sales and delivery reliability, JD is the gold standard. Fifth and final question. Will JD's industry and products remain relevant over the long run? Here I give it 5 out of 5. E-commerce, healthcare, and food delivery aren't fads. They're long-term secular trends in China and globally. As income levels rise, demand for quality, convenience, and speed will only grow. JD's diversification across retail, healthcare, grocery, and international markets ensures it remains relevant even if core e-commerce growth moderates. So in summary, JD scores very well across these 5 dimensions, with an overall average of about 4.6 out of 5. That's a strong endorsement of its structural strengths and long-term potential. Of course, challenges remain: macroeconomic uncertainty, competition, and regulatory risks. But from a fundamental perspective, JD is far from being a broken company. Let's take a closer look at JD's debt and overall leverage. The company's total liabilities are about 58% of its assets, so just over half of what JD owns is financed through obligations. Now, not all of these liabilities carry interest. The portion that is interest-bearing, things like loans and bonds, comes to around RMB 71.8 billion, giving JD a debt-to-equity ratio of about 24%. That's a moderate level of leverage. Nothing alarming. The rest of the liabilities are mostly operational items: accounts payable, accruals, and deferred revenue, which are generally interest-free and part of day-to-day business operations. Here's the comforting part: JD's liquid assets, cash, cash equivalents, and short-term investments, excluding receivables, total about RMB 223.4 billion. That's almost exactly enough to cover its short-term debt and payables, which are roughly the same amount. On top of that, JD's interest coverage ratio is very strong, with an operating income of RMB 38.7 billion and an interest expense of RMB 2.9 billion. The interest coverage comes out to 13.3 times. This means JD earns more than 13 times what it needs to pay interest, providing a wide safety margin and reinforcing confidence in its ability to service debt comfortably. In other words, JD has sufficient liquidity to meet its immediate obligations without stress, a strong sign of financial health. JD consistently generates positive operating cash flow, which is a key indicator of the strength of its core business. Over the years, operating cash flow has grown steadily in line with the company's revenue expansion, before stabilizing at a high level of around RMB 58 billion in the past 3 years, reflecting both scale and operational efficiency. This magnitude of this cash generation is significant. It allows JD to fund its capital-intensive logistics expansion, build new fulfillment centers, and support innovative initiatives without compromising liquidity or financial flexibility. It also means that JD can service debt comfortably and maintain operational resilience even in the face of macroeconomic or sectoral headwinds. That said, JD's recent entry into food delivery required heavy upfront investment, creating a temporary cash crunch. In fact, this contributed to a 55% drop in free cash flow in Q2 2025, from RMB 49.6 billion to 22 billion. This is normal for a new segment that's scaling rapidly, and it's not indicative of underlying weakness. Once the segment matures and daily orders stabilize, cash flow pressure should ease. In short, JD's cash flow is robust and resilient, allowing the company to continue investing in growth and shareholder returns. Let's review JD's valuation. At a market price of around HKD 130, its PE ratio is less than 9, an exceptionally low level that signals very modest growth expectations from the market. Even if we take a conservative view and assume JD's revenue only grows in line with China's GDP, 5% annually over the medium term, the outlook remains compelling. Historically, JD's earnings have grown much faster than revenue thanks to operating leverage and efficiency gains. From 2022 to 2024, revenue rose about 10%, RMB 1.05 trillion to 1.16 trillion, but underlying profit more than doubled from RMB 19.7 billion to 38.8 billion. To stay pessimistic, let's assume this effect weakens, and every 10% revenue growth drives just 20% earnings growth. With forward revenue growth of 5%, that's still roughly 10% earnings growth, giving JD a PEG ratio well below 1. In other words, the stock is priced like a no-growth company, but its fundamentals suggest otherwise. Independent valuations suggest JD's Hong Kong shares are significantly undervalued. Estimates range from conservative HKD 175 to 473, implying upside of 34% to nearly 360% from current levels. Even on the low end, the stock trades at a deep discount to intrinsic value, supporting a bullish stance for long-term investors. Personally, I prefer to calculate JD.com's intrinsic value using my own DCF assumptions. Assuming free cash flow grows 10% annually for the next 5 years, in line with the conservative earning growth assumption, and a 3% terminal growth rate thereafter, the intrinsic value comes out to HKD 328 per share with 10% discounted rate. This aligns closely with AlphaSpread's estimate. Importantly, these figures are derived from very conservative growth assumptions, underscoring the potential upside if JD continues to leverage its operational efficiency and new business segments. Now, there are a few potential upside surprises that could help transform JD into a true long-term compounder. First, earnings surge by operating leverage. JD runs on a high fixed cost base. That means even a small increase in revenue can translate into a much larger jump in earnings. We've seen this historically, and if the macro environment improves, JD's profits could surprise sharply to the upside. Second, the macro reform. I don't believe in massive short-term stimulus from Beijing, but I am positive about China's long-term economic reforms, shifting toward a high-income, consumption-driven economy. That kind of environment favors JD, which focuses on quality goods and services. If the macro trend plays out well, JD is well positioned to capture it. Third, the dividend story. JD already pays a dividend with a yield of about 3.2%. But the payout ratio is very modest, just around 22 to 25%. That gives the company plenty of room to raise dividends in the future while still investing in growth. JD has the potential to evolve into something rare in China tech, a growth and dividend play, appealing to both growth investors and income investors. And finally, spin-offs and REITs. JD has spun off JD Health and JD Logistics in the past, and more recently, it's been monetizing its logistics properties through REITs. Honestly, the past spin-offs didn't deliver direct benefits to shareholders, and the market reaction was pretty muted. But over the longer term, these moves still help JD optimize its capital structure and free up cash for reinvestment. And while the benefits are indirect, they could eventually give JD more flexibility, more optionality to return value to shareholders. No investment is without risk, and JD is no exception. Here are the key areas to keep in mind. Consumer trends in a prolonged slump. If China's economy faces a prolonged slowdown, consumers may shift toward a thrift-driven economy, where low price takes priority over quality or brand. In such a scenario, JD may only be chosen when speed is absolutely essential, like for medicines or urgent deliveries. While for regular purchases, consumers could migrate to cheaper platforms. Competition, rivals like Alibaba, could still attempt to win back market share. The good news is that JD's high-speed delivery system has created a formidable barrier to entry, making it less likely competitors can easily replicate its model. Still, competitive intensity is always a risk in Chinese e-commerce. Management focus, JD, has so far managed its diversification, such as food delivery, in ways that maintain synergy with its core operations. But as the company grows larger and explores overseas ventures like its stake in Seaconomy, there is always the risk of losing focus. Over-diversification could lead to capital being tied up in businesses that don't deliver the desired returns. Regulation. The CCP's crackdown on tech monopolies in recent years highlighted the regulatory risk facing all Chinese tech firms. While the pressure has eased recently, policy remains a variable that can quickly change the operating landscape. Inflationary pressure and margin compression. JD's strategy relies heavily on logistics and service quality, which are capital intensive. In an inflationary environment, rising labor costs, fuel prices, or regulatory wage requirements could pressure margins, making it harder to sustain profitability even if revenue keeps growing. While none of these risks appear to be immediate threats, they remain important signposts to watch. For long-term investors, vigilance is key. If the business environment shifts toward these risks, whether it's prolonged consumer thrift, regulatory tightening, or margin pressure, JD's growth story could face challenges. Staying alert to these risks is part of maintaining conviction in the investment. Here's the summary and my take on JD. Growth and moat. JD checks all the boxes on Philip Fisher's framework on growth prospect and competitive moat. Its strong brand, massive logistics network, and ability to expand into new markets give it the qualities of a long-term compounder. Financial health. The company is financially solid. With strong cash flow and a healthy balance sheet, JD can weather short-term headwinds while continuing to fund its growth plans without strain. Valuation. At HKD 130, the stock trades far below intrinsic value estimates, both from analysts and from my own conservative DCF models. That valuation gap provides a wide margin of safety and meaningful upside. Room for upside surprises. JD's high operating leverage, exposure to long-term structural tailwinds in China, potential to become a growth plus dividend play and spin-off initiatives all add optional upside that could boost returns beyond base expectations. Potential risks? Consumer shifting into thrift-driven economy in a prolonged slump, competitive pressure, management distraction from over-diversification, regulatory shifts, and margin compression are the key risks. None of these appear immediate, but they're important to monitor for the long-term investor. My take. JD offers an extremely cheap valuation with the potential to compound over time. It is financially very strong, and while risks exist, they don't appear immediate. For long-term investors willing to stay vigilant, JD looks like one of the best risk-reward plays in China's tech and e-commerce space today. And as always, the above is just my personal perspective. It does not constitute financial advice or any buy or sell recommendation. Always do your own due diligence and seek guidance from licensed financial advisors. Please feel free to leave your comments. Goodbye, and have a great day.